Russ Squire again, president of Big Sky, or excuse me, 1031 Property Exchange. And we are going to be delivering part two of our seminar, Using 1031 Exchanges to Grow Your Real Estate Wealth. So let's get right into some basic 1031. There are 5 basic rules for 1031 exchanges. 1, both the relinquished property and the acquired property must be held for productive use in business, trade, or for investment purposes. 2, the proceeds must be exchanged through a qualified intermediary. You can't use a related party, and we'll get more into what a related party means in a subsequent presentation. Also, a qualified escrow account has to be used to hold the relinquished property proceeds during an exchange, unless you're doing a simultaneous exchange, which would be when 2 people swap land. Don't see those very much anymore. Very few people ever use a simultaneous exchange. They're always delayed exchanges. Number 4, all the cash proceeds from the relinquished property or property you're selling must be reinvested in the replacement property that you purchase, or else you create taxable boot. And number 5, the replacement property must be subject to an equal or greater level of debt then the replacement property, or the exchange will have to pay taxes on debt reduction or put up cash to offset the lower debt level in the replacement property. So if you had $100,000 in debt on a property you're selling, you're going to have $100 on the property you're purchasing, or else you're going to have to pay taxes on that debt reduction. So let's talk about the 1031 Wealth Machine, TLC. It's an easy way to remember it: taxes, leverage, and compounding. You know, the power to defer taxes. Defer, 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 die. That's the battle cry. But essentially, if you defer taxes long enough from 1031 exchange to 1031 exchange, eventually when you die, your heirs will receive a step up in cost basis. And it'll either be a step up to the date of death value or 6 months following the date of death, depending on how the executive or your state decides to plan that one out. So there is the ability to pass all the gains from exchanges tax-free. The power of leverage. The leverage power of dollars saved in a 1031 is enormously powerful. If you have a property that's, say, $1 million property and it's got $400,000 worth of gain in it, and then you look at the combination of federal estate or federal capital gains tax, state capital gains tax, and then depreciation recapture, you know, you might be looking at several $100,000, but that several $100,000 in taxes paid is going to multiply over a longer period of time, like 20 years, and become an enormous amount of money. And you can't multiply that which you don't keep control of. So if you give it away to the government, you're not going to get a chance to multiply it. Increase your cash flow. You know, you can convert non-income producing property into income producing property. I see this all the time. People own a piece of raw land. Well, raw land, you can't depreciate it. It doesn't create any income. But you can sell that raw land using a 1031 exchange and then use it to buy a piece of property that doesn't produce regular monthly income. So that's another one of the beauties of 1031. And then finally, you can buy better property and shed management responsibilities. You know, get into higher quality properties, stuff that doesn't have as much deferred maintenance. Maybe it's a little newer, and you know, put it with a property manager and not have to worry about day-to-day operating responsibilities. That's, you know, that's what makes it, owning investment property, a good retirement strategy. Defer taxes. Let's take a look at that. Deferring capital gains tax on income and investment property allows for a step up in cost basis at date of death to your heirs. So that eliminates the taxes owed, making all that deferral into a tax-free transfer. Now you see the asterisk there, of course, it says estate taxes notwithstanding. But, you know, as of 2014, you're looking at about 5.24 million, I believe it is. That's excluded from federal estate tax. So unless your estate is really large, chances are there isn't much you have to worry about. If it's a really large estate, you know, there are separate things you can use, like high exemptions, trusts, you know, other sophisticated estate planning tools. But estate taxes are a separate issue, and they're caused by that overall size of the estate, not by, you know, a 1031. Okay, so taxes on the sale of real estate will increase your adjusted gross income, and this is something to keep your eye on. If you do sell a piece of real estate, don't do a 1031. it can be added to your AGI, or adjusted gross income, and you can lose your itemized deductions, medical deductions, IRA deductions, child care deductions. And if your AGI is too high, 1031 can help solve those problems. Of course, the other problem is a large increase in your adjusted gross income can cause the taxpayer or exchanger, meaning you, to get pushed into the alternative minimum tax bracket. And that is a significantly higher tax rate than ordinary income, and also much, much higher than capital gains tax rates. So, the power to defer taxes is a very, very powerful tool of 1031 exchange. The power of leverage and compounding. And of course, as you can see down there at the very bottom of the slide before I get into it, picture of Albert Einstein. And Einstein once said, compounding is the eighth wonder of the world, and it's all too true. So, $100,000 tax savings on an $800,000 property sale. Let's say that's what you have. And it means you can buy another $500,000 in real estate at a 20% loan to value ratio. So, let's say with a 1031 you sell that $800,000 property, pay no taxes. You assume $300,000 remaining on a note. That's the note you had on the property you sold. You buy a new property, increase that note to $700,000. So your equity is $500,000 on a $1.3 million property. At 6% compounding, that would turn into $4.16 million over 20 years. So without 1031, you sell a property and pay $100,000 in capital gains and state income taxes, leaving $700,000. Take out the same $300,000 in debt to buy replacement property and add your initial equity, which is now down to $400,000 because you lost $100,000 to taxes. That allows you to purchase a $700,000 piece of property, and at a 6% rate of compounding, it turns into $2.24 million over 20 years. So the point of this example is that not doing a 1031 exchange costs you almost $2 million worth of wealth building potential over a 20-year period of time. And once you lose the pile, you can't get it back. The government's not going to be writing any rebate checks for money paid in taxes, that's for certain. Increase your cash flow. Raw land doesn't cash flow. Can't be depreciated. There are no income or tax benefits. The only benefit is appreciation. So, convert raw land via 1031 exchange to triple net lease or multifamily rentals, and you'll gain from positive cash flow. The depreciation allowance will help your taxable income, and you have appreciation potential. And shed management headaches. Investors with older rental properties often are going to have large future maintenance expenses. And they can use a 1031 to buy newer property that will require less maintenance. Older properties with reduced debt levels normally also have high cash flows. And as their depreciation allowance grows smaller, they can begin producing what's known as phantom income. And that's income you have to pay more taxes on. Hiring a property manager can alleviate a lot of tenants and toilets and trash headaches, and still maintain a positive cash flow, especially if you've got an older property you're doing a 1031 on and you've got a high equity position. You might get to a point in your life where you go, I don't want to do this stuff anymore. I just want a check. Somebody send me a check. Triple net lease commercial, no question, the undisputed king of solving real estate management headaches. So it's something to consider if you've got enough money invested in rental properties. I'm going to keep this one short as well, and in part 3 what we'll do is we will introduce what I think is the most powerful section of the whole entire seminar, our 1031 exchange super tips. I think you'll learn a lot from it, and appreciate your, need any consultation or have any questions, just feel free to call me personally at 406-425-2742. This is Russ Squire for 1031 Property Exchange.